Hey guys, welcome back. My name is Riado, and if you're new to this channel, I analyze some of the most innovative companies in the world and help you find the companies of tomorrow. So this is part 2 of my meta stock analysis, and if you're interested in watching part 1, where I talk more about the company and its growth, you can click in the link in the description down below. With that said, let's get on to part 2 of the video. So turning to the profitability of the company, Meta generated gross profit of $91.4 billion, which is a 78% margin, and this is a decrease from 81% margin in 2021. So the decrease was mainly due to an increase in operational expenses related to its data centers, and the company also recorded 1.3 billion abandonment charges related to data center assets. And on the other hand, these increases were partially offset by a decrease in Reality Labs inventory costs. So Q1 gross profit was $22.5 billion, which is a 79% gross margin, and as you can see, gross margin has been pretty stable over the last few quarters. So despite external pressures, Meta is still able to maintain high gross margins, which shows strong pricing power, strong demand for its products, and high earnings potential for investors. So moving on, operating profit for 2022 was $28.9 billion, and it is down 38% year over year, which is a 25% operating margin. So the decrease in operating profit was mainly due to a 20% increase in employee headcount, and management has talked about the year of efficiency and they're doing everything they can to make Meta a leaner, more profitable business. This includes announcing multiple rounds of layoffs as well as a pivot in its data center strategy, which resulted in total restructuring costs of $4.6 billion. So in Q1, operating profit was $7.2 billion, which is a 25% margin, an improvement from Q3 and Q4. So operating margin improved quarter over quarter as the company completed the 2022 employee layoffs of about 11,000 employees. That makes Meta's employee count to about 77,000 as of Q1, which is down 11% from the fourth quarter. So in Q1, Meta announced 3 more rounds of planned layoffs to reduce the company size by another 10,000 employees. As such, Meta is expected to incur additional restructuring charges in the near term, but once the layoffs are complete, operating margins should improve significantly. For example, restructuring charges for Q1 was about $1.1 billion, and excluding these charges, operating margins would have been 29%. So continued investments in product innovation, particularly in the RL segment, are also pressuring margins, and as you can see below, these are the operating profit by segment. So in 2022, family of apps have $42.7 billion of operating profit, while Reality Labs have an operating loss of $13.7 billion. As you can see, family of apps operating margin was 40% in Q1, while Reality Labs has an operating margin of negative 1,000% plus. But fortunately, the operating profit from family of apps is able to cover the losses from Reality Labs. So management clearly stated that they're investing heavily in the metaverse, which explained why R&D remains the highest component of operating expenses as shown below. It says that the company is investing heavily on cutting-edge research and development for products for the metaverse that are not on the market today and may only be fully realized in the next decade. So the company expects RL segment to continue to operate at a loss for the foreseeable future. And this is going to be a complex, evolving, and long-term initiative, and the company believes that this is the next chapter of the internet and will unlock monetization opportunities for businesses, developers, and creators, including advertising hardware and digital goods. So despite ongoing RL investments and macro headwinds, Meta is still a highly profitable business with net income margins of about 20%. They generated $23.2 billion in net profit in 2022, and in Q1, $5.7 billion in net income, which is a 20% net margin. All in all, Meta's facing margin pressure due to a challenging macro environment as well as ongoing investments in the metaverse. In essence, Meta is sacrificing short-term profitability for long-term growth, and we should see margins continue to be suboptimal in the medium term. That said, Meta is a highly profitable business with high earnings potential, and moving forward, we should see margins improve as the company pivots to a leaner business model with fewer employees. employees. Now let's turn to the balance sheet of the company. As of Q1, Meta has $37.4 billion in cash and short-term investments with $27.5 billion in total debt. That makes their net cash position to be about $10 billion. As you can see, net cash has been dropping over the last few quarters, and this is due to the company buying back its own shares over the last few quarters. Current ratio is also at 2 times, which is pretty liquid and healthy. In 2022, Meta generated $19 billion of free cash flow, which is a 16% free cash flow margin. So the combination of high free cash flow, high net cash position, and plummeting valuation are why the company has been buying back shares aggressively. So for context, in 2021, Meta bought $44.5 billion worth of its own shares. In 2022, Meta bought back $28 billion of shares. And in Q1 alone, the company repurchased $9.2 billion of stock. And Meta also authorized another $40 billion of repurchases, which brings its buyback capacity to about $41.7 billion. So yes, with the increasing free cash flow that we've seen in Q1, I do expect the company to buy back more of its shares in the coming quarters, especially if we see a major pullback in the stock. So all in all, Meta has a strong balance sheet and the company is also highly profitable, generating loads of cash in the process. And that means Meta has the opportunity to reinvest into growth and buy back shares, which should reward shareholders in the long run. So turning to the outlook of the company, management provided the following guidance. The company expects Q2 revenue to be in the range of $29.5 to $32 billion. So taking the midpoint guidance, Q2 revenue is expected to grow by 7% year over year, which is an acceleration from Q1's revenue growth of 3%. So that is really upbeat guidance from management, which is why the stock is reacting so positively. So the company also expects full year 2023 total expenses to be in the range of $86 to $90 billion, which includes a $3 to $5 billion of restructuring costs. The company also expects Reality Labs operating losses to increase year over year in 2023. And finally, capital expenditures is expected to be in the range of $30 to $33 billion as the company invests in AI capacity to support ads, feeds, and reels, as well as generative AI initiatives. So CFO Susan Lee also explains why revenue is expected to accelerate in Q2. So she mentioned that it's going to be easier year-over-year comp, coming from lapping a weaker demand period and then moving into the first full quarter in Q2 without Russia revenue. And she also adds that currency is also going to be less of a headwind in Q2. So here are some other things mentioned in the earnings call that could give us a hint on what the near-term outlook looks like for Meta. So Zuckerberg mentioned that last quarter that click-to-message ads reached a 10 billion revenue run rate. And since then, paid messaging on WhatsApp has grown 40% quarter over quarter. So really strong growth in the business messaging department. Zuckerberg also mentioned that the company is launching its next generation consumer virtual and mixed reality device later this year at a price point that will be accessible for lots of people. So that is something to be excited about. So if we head on to Seeking Alpha, we can see Meta's actual performance compared to consensus estimates. And you can see that the company has been outperforming expectations more times than not. So with that said, we could expect the company to outperform expectations moving forward. And also, I think it's worth mentioning that there's a catalyst to the stock. There's talks of regulators trying to ban TikTok over privacy concerns, as Chinese officials may have unlimited access to sensitive data. So if TikTok is taken down, we could see a massive migration to Reels, which will probably spike engagement, user growth, and maybe revenue for Meta. In another scenario, ByteDance may spin off TikTok, which I think is the most likely outcome, but I think a spin-off is already priced into the stock. So an outright ban will be a major catalyst for Meta stock. And speaking of Meta stock, let's take a look at the company's valuation. You know, just by looking at Meta stock chart, you might mistake it for a high-flying, unprofitable small-cap stock. I mean, in a span of just 1 year, Meta stock traded as high as $380 per share to as low as $90 per share, which is just unheard of for a wide moat, free cash flow generative mega cap company. And as of this video, Meta trades at about $240, which is roughly about 160% above its November lows of $90. So what really caused the stock to rally that much even with worsening growth and profitability metrics? I think it's due to a change of sentiment, especially when the company announced its first round of layoffs and then the next and then the next. I think management's focus on the year of efficiency as well as the company's buyback program gave investor confidence. The question is Meta stock still a good buy after the rally that we've seen so far? So if we look at Meta's valuation multiples, it seems that the company is trading at fair value. So here you can see that the company is trading at a PE ratio of 28 as well as a price to free cash flow multiple of 34 times. So this looks like the company is now trading at its historical averages. Just for full disclosure, I was buying the company at these levels when valuation multiples were really compressing to, to levels that were not seen before. And now valuation multiples have expanded back to its historical ranges, and that's why I don't think it's really that attractive at current prices. So if we head back to Seeking Alpha, we can see its valuation compared to peers. So based on the PE ratio, Meta seems to be trading at a cheaper valuation than Apple and Microsoft. And also based on other metrics such as EV to EBITDA and price to cash flow, Meta seems to be the cheapest even comparing to other smaller peers such as Pinterest and Snap. And yes, even though Meta has a lower growth rate than some of its peers, I think the valuation multiples compared to peers is still too cheap to pass up. And here we can see analyst price targets, which is an average of about $223 per share, which represents a 6.6% downside. So Wall Street has a low target of about $80 to a high of $305. And also I like to do a sanity check on analyst price targets by doing a DCF model of my own right here. And as you can see, these are the historical results and these are my projections. So here are my key assumptions that drive my DCF model. So for revenue growth, I'm going to follow analyst estimates for the first 3 years, and then I'm going to bring down revenue growth slowly down to 5%. So for cost of revenue, I'm expecting that to drop from 20% to 17% by the end of 2032 as the company gains economies of scale. And for operating expenses, I expect that to drop from 52% this year to about 42% by the end of 2032. For income tax, it will be set to 20% for all years. Depreciation and amortization will be at 7%. And stock-based compensation will drop from 8% this year to about 6% in 2032. For CapEx, it's going to be about 26% of revenue this year and dropping it down to 15% by 2032. So I'm following management's guidance of $30 billion to $33 billion in CapEx in 2023. So for changes in net working capital, the average is about negative 2%. So I'm going to use that for the rest of the years. So based on these assumptions, I have the following DCF output. I'm expecting free cash flow margin to be about 13% and improves to 32% as the company achieves operating leverage. And using a 10% discount rate as well as a perpetual growth rate of 2.5%, I arrive at an intrinsic value per share of $274 per share. So this is quite a bit higher than the analyst price target of about $223 per share. So with an intrinsic value per share of $274, I think the company has an upside of 14% based on the current price of $239. So if I wanted to add to the stock, I will wait for the company to drop to my margin of safety price, which is about $191 per share. Perhaps the reason why Meta stock sold off so much in 2022 is due to the fact that many think that Meta's revenue will take a massive hit as companies all over the world pull back ad spending amidst a global recession. While that may be true, the advertising industry is much more resilient than many think. Take Google for example, which is also an advertising business. So revenue barely dipped during the great financial crisis, and we could potentially see the same scenario for Meta, where we see a slight revenue drop followed by a quick recovery. And I think it's already starting to show in Q1 results. So fundamentally, Meta has a resilient business model with strong competitive advantages, but its price chart reflects a broken company with a broken stock, which is why I bought Meta late last year, and even Meta has been buying back its own shares aggressively. And at today's price, even with the rally that we've seen, I think the company is still undervalued, and I think we can still see some upside in 2023. So turning to the risks of the company, I think the first major risk is competition. While Meta remains the global leader in social media, we can't completely ignore the competition. So as shown in this chart, we see that the average TikTok, YouTube, Twitter, and Snapchat user spend more time than the average Instagram and Facebook user. So losing user time and attention to competitors meant less monetization opportunity for Meta. And in addition, Apple is also working on its own AR/VR headset, which would likely add pressure to Meta's RL sales. The next major risk is policy changes. As you all know, data privacy changes and other regulatory developments could significantly impact Meta's operations. For example, Apple's 2021 iOS update allows iPhone users to opt out of in-app data tracking, which led to an estimated $10 billion impact on Meta's advertising business. While I think Meta is quick to respond to changes, such policy and regulatory changes could still weigh down on the stock, at least in the short term. And finally, it's the sunk cost fallacy. And this is a phenomenon whereby a company is more likely to continue with a project because they have invested heavily in it, even when it's clear that shutting down the project will be more beneficial. Having invested billions into the metaverse, Meta could be a victim of the sunk cost fallacy, and after all, the metaverse could turn out to be not as good as what management expect. So wrapping up this video, I think Meta is going through some challenges, and I think a lot of people think that this is going to be a permanent problem that will never get solved. So this includes competition, slowing growth, and weakening profitability, and I think these headwinds are temporary and it's only a matter of time before conditions improve. And things are actually improving as we've seen in Q1 results. Engagement, user growth, and revenue are all returning to growth mode. And plus, the company has strong balance sheet and competitive advantages to protect it from external threats. So yes, I did buy the stock in October and I'm sitting in the green, and I'm going to sit still because I think the company is still undervalued. And I think the year of the efficiency, the $40 billion share buyback, the family of apps returning to growth mode, and the metaverse finally taking off, they could set the stock nicely for the next few quarters or even years. Well, that's my thoughts on Meta platforms. What do you think about Meta stock? Please let me know in the comment section down below. And if you like the video, please hit the like button and subscribe to my channel so you won't miss future videos. With that said, thank you guys. See you guys on the next video.